you're doing mostly existing storage, right? So forced equity models.
Correct. Yeah. And I think the sweet spot, and no surprise, but is secondary, tertiary markets. I know we're a bunch of Texans on the call here, but I think enough people have been to Austin or can picture downtown Chicago. When you're the heart of downtown, that's class A. These things are silly expensive. It's like an Amazon warehouse. It's literally a sub 5, maybe in the 4s cap rate. As you get to secondary, tertiary markets, this is a sweet spot. And taking a little step back, what I love about storage is multiple things, but two things especially. First of all, it's not regulated. And when I say that, it's not like community banking where there's so much regulation. Every Google search you're going to be there. I mean, the three of us can stand up a storage facility across the street, and we don't have to join an association. We don't even have to have a website if we don't want. You can have that storage facility up and going. Now, obviously, I would do that, but that's the first thing. The second thing is 4 out of 5, so 80%, 40,000 out of 50,000 of storage facilities are owned by a mom and pop. And that's when you think about that, like if for the account U-Haul, the 5 REITs or 6 REITs, the next top 100 are relatively a small percentage of the total market. So what I like about storage is somebody can still outwork somebody else and have a successful career as an owner operator.
Yeah. One other piece, and back to your first point, I imagine the laws that self-storage comply to are around personal property, which is far different than real estate as property, because you think about tenant laws and all that. If someone doesn't pay their rent, you evict them the next day.
Sure. Yeah. The one thing I would say, as a caveat, and this is a little surprising because, storage is kind of like I have a 5-year-old. It's kind of like Legos. You put up a box, you can shift the sizes. Permitting, particularly as you get to, it could be large towns, small towns, could be an issue. So as simple as it might seem to say, hey, we're going to buy this plot of land and then, buy all the material and then build a box. The powers to be at this municipality may not allow that. And then there's also comical things where like the front has to look like a medieval knight sort of castle, but the back can look like storage. It's silly, but that can happen. So I would say that's just one, cautionary thing for particularly folks that like to develop versus more being value add. That's why I think there's still a lot of meat on the bone here with these kind of value add properties that you can take advantage of because they are fully permitted.
What are some of the deal economics? The last deal that you did in storage, you and I have worked on some capital raises, clearly with BV Capital. And, you're seeing 20% IRR with, a 2X all-in multiple, maybe a 3 to 5 year hold period. Similar deal economics that you're seeing in the storage space?
Yeah. So right now, when you see a portfolio, you're going to see about an 18 IRR, probably over 5 to 7 years. And the reason is that folks want to be conservative in their timeline when they add properties, and they don't want to sit on cash. So in some ways, it's kind of like a rolling close, effectively, that you see in a fund. Now, for a one-off, you could get something crazy sizzling. I'll talk on that in a minute. But then when it's, I'll say, a lowercase portfolio, meaning when an operator puts together a bunch of one-offs and sells it, this is where you can get, a 3X or more on a particular property. So let's just say it's a 10 property portfolio. If you're investing in property 8 or 10, you get the benefit of, these first 7, 8 properties. So from an IRR perspective, you might get something comical. In this last thing I was with, and I was more of the early investor, one of my junior employees, he invested towards the end, ended up 3Xing and was able to, put a down payment on a house. Like, wow, great story. And when people talk portfolio, is it a formal portfolio or is somebody moving there? The other thing I would share is what's different in storage versus, say, multifamily. Multifamily, you want a round trip really quickly, particularly your first property, say you sold. Storage, you actually want to get to 10, 15 plus, then you're on the radar of the REITs for acquisition. So storage is a bit of an odd duck in that thing. And the final point I would share is, to the property itself, I feel for a quote unquote good operator, meaning think like COO sort of type, there's a huge year one bump and then it kind of goes linear. And I share this meaning because let's say you have 2 really strong operators. An operator buys from a mom and pop. Right off the bat, you can get year-over-year operational returns up 16%, basically on day one. So this let's say in year 3, shop B comes to buy it, they're going to still ride that wave. So I share that because, and an honest pref is probably a 6 or 7. Some people probably do an 8, but I think in terms of say, hey, if I were to invest in storage in the spirit for perpetuity or for 7 to 10 years, you're going to continue to ride this wave if you have a good operator, even if that property is kind of flipped with it.